Hello, everyone. Thank you very much for joining this webinar. My name is Nick Charalambous, and I'm the Managing Director of Alpha Wealth. I'm just going to give it a couple of moments just to allow one or two more people to join, and just while the numbers are settling. For those of you that had listened just to that video recording, that was Jerome Powell, the Chairman of the Fed, who was speaking yesterday. This webinar has been recorded on the 20th of March, who reassured markets that America was actually in relatively good condition. The Fed left rates unchanged, which wasn't unexpected, and it's basically reassured markets. And we've actually had a bit of a bounce since that announcement. So, as I said, really what I'd like to get across today is that this is a webinar based on helping you to understand about where we are in the world and how to get the most out of your pension savings and investments in what we've coined the Trump era. So I'm going to spend the next 30 minutes or so just running through some key areas that I feel would be relevant for all of us. For those of you not familiar with Alpha Wealth, we're a very progressive financial services provider. We have 12 employees in Cork and Dublin, and we would like to suggest that we have a lot of experience in helping people navigate the different aspects of dealing with our finances, particularly with volatile times that we face. So just in terms of trying to understand around the webinar today, if anyone does have any questions, please do pop them into the chat. I will try and get my video working, but I will continue in that. I'd like to maybe make reference to some of the slides that are on the screen. So just to move on, basically the main takeaways from today are what has happened and why. What should you do about it? If you're in a position to essentially give yourself the opportunity to make any changes, what should they be? And then finally, how you should look at trying to approach the future and what you should be looking to do. So starting off, looking at maybe the past, we've had 2 years, 2023 and 24, where investment markets have performed very, very well. 24 was an unusual year. We had a record number of elections, and there was a lot of uncertainty around a number of things, including Trump's election. But the year finished incredibly well, and we saw growth of over 20% in equity markets. However, even though the year started very well, a month ago, on the 19th of February, it started to change. We heard more about the tariffs, and I'm going to explain a little bit more about other reasons why markets fell. But you can see there that if you look at the middle slide, the S&P 500 index, as of last night, it was down about 7%. And yet the night before, it was down 8.24%, which is what I referred to earlier around the comments that obviously Jerome Powell made. And if you look at the right-hand side of the screen, you can see there that a number of asset classes are negative since the 19th of February. But some of them have performed, such as gold, and indeed certain other asset classes like the euro dollar. Now, again, I'm not going to get into currencies today, but there's many different facets to our investments, and we just need to be very cognizant of where do we have exposure. A lot of people have a lot of exposure to the Magnificent Seven. These are these so-called seven, mostly tech companies that have performed extremely well and make up over 30% of that S&P 500. So imagine 500 companies and over 30% of it is made up of just seven of them. And whilst markets were doing very well, we all benefited massively from their performance. A lot of people would have obviously exposure to these companies having worked in them. However, you can see there that 6 of 7 of them are negative year to date. Some of them are negative quite largely, Tesla being the one most poignant, which is the bottom one on the chart there. And so it just goes back to explaining around how we should look to try and make sure that we don't have overexposure in any particular market. I mentioned there gold being one of the very few positive asset classes this year. And that has been mainly driven by the fact that emerging market central banks have been hoarding gold in response to some of this uncertainty. And like most asset classes, it's driven by demand and supply. And you can see that despite some up and downward movement, its performance has been positive, not just year to date, which is up about 8%, but it was the best performing asset class last year with returns of over 40%, which is considerable. And many people think that that's not going to continue, and I'm not convinced that that's going to be the case. So let's look at why has this happened. Well, I've already mentioned about the tariff war that Trump has, I suppose, elected. And that's been, I suppose, quite well noted in the press. But there are many other reasons. Consumer confidence, as Jerome Powell had mentioned, is not as buoyant as it was. Some of this uncertainty that we're seeing does cause businesses to hold back on expenditure for expansion, for example, or new hires. There are some inflationary worries. Also, because of the, I suppose, improvement in performance in a lot of stocks over the last 2 years, people are saying that some valuations look expensive, particularly in the AI-driven companies. However, again, I would suggest to everyone that's listening on this call, one of the largest takeaways that I can give you today is nobody knows what's going to happen over the next month, year, 5 years. The purpose of today's webinar is to try and help you ensure that you're positioned in the event of things performing badly, but also in the event of things performing well. And this goes back to this diversification and how I feel we can best position
Nick,
ourselves.
before you move on, sorry, there's just been a question in just to say that this all looks quite negative. What should somebody do in this position? Like, should they, with savings and pensions, given what you've outlined there?
I'm going to cover this off in a bit more detail, but it's a very good question. I mean, the fact is that the press, and I have some article cut-ins from the last number of weeks, always point the negative picture, and it's driven by what we see on social media, it's driven by what we hear in the news, it's driven by seeing our own investment portfolio fall. And again, if you look at what's been going on, we've seen a lot of negative news about Trump. The fact is that this is different this time around. We don't generally tend to hear that on Friday of last week, which was the 14th of March, we had the biggest gain since November, and yet that gets typically rubbed under the carpet. I mentioned about obviously Jerome Powell reassuring markets yesterday and the tone that he left, which was quite what they call reassuring. But a lot of people don't realize this because, again, it's not the thing that we see on the 6 o'clock news. And just to be very clear about what's happened over the last month, guys, and I don't want to get into too much jargon, but it's known as what we call a correction. A correction is where the market falls by 10% on its record high, and that has occurred. It happened last week, but it's subsequently now fallen within the 0%, 10% banner. So it's essentially not correction category, which we're in now. And by the way, a crash is even more stark, where we see a 20% plus fall in markets. And a bear market is where we experience that over a prolonged period. So we're nowhere near events that we've seen happen, particularly what some of us remember from 2008. Now, I'm not saying that it cannot happen. I'm just explaining to you that it has not happened yet. And there's no reason, based on what Jerome Powell was saying yesterday, that we have to believe that it will. And the key things are, when we look at what has taken place, it's not really unusual. This, what we know as this bull market. And again, what is a bull market? It's where markets go up. And I said to you that it's happened over the last couple of years. Normally they last for more than 5 years. So we're still very early in what we call this cycle. There's been 48 corrections, the 10% plus falls since the Second World War. So it's not that it's totally unexpected. We've experienced 2 bear markets even in this decade. So again, we can't believe that this time it's going to be different. And the key thing is that if you zoom in on the last month, which is the bigger slide on the graph there, this 8.24% that I mentioned, and I'm only using one index, which a lot of people refer to as the stock market, even though it truly isn't. It's only the 500 companies in the States. And albeit that the States makes up a lot of the market, you can't say that this is the world market as a whole. The European market, by the way, is up year to date. But if you look at a wider picture, and the same index over the last year is up 8.42%. And over the last 5 years, up 143%. it just goes back to what I was saying, is that you can't have this short-term view when it comes to your investments. And as much as it can be painful to see the value of your pension fall by 7, 8%, or indeed any investment you have, we have to remember you've got to take the rough with the smooth. And if you look at this over a 12-month or 18-month picture, you would typically be in positive territory. Looking at the S&P 500, which again, I'm not a massive fan of talking about it being the market, but a lot of commentators see this as, you can see all the blue lines, which are the ones that typically are where we've made a gain in the year. Notably, 22 was a negative year, the last one that we experienced. One of the big pullbacks we saw was back in 2008, where we saw markets obviously fall considerably. That was in some cases over a 30% fall. And the thing is, the market did recover. We've seen a 500% recovery since the lowest point of 2009, which is when the market stopped falling. So that leads me to, what should we do now? And I refer to the average person, and this is not in any way trying to be, I suppose, condescending, but what people tend to do is panic and react. And the key thing is that we try not to do that. Not because we're not afraid of losing money. No investor I've ever spoken to is comfortable about losing money. It's about the fact that unfortunately we tend to time these things incorrectly. You know, you get out after the fall has happened and you don't re-enter before the recovery starts. Waiting for the right time to invest. I speak to many people. I had a call earlier today with someone that said that they were waiting for a further pullback because they expected that there may be one coming. And the key point I was trying to make is that we never know. And by you being out of the market, you're more likely to miss out on when that upturn takes place. As I've mentioned, in my opinion, what we've experienced since last Friday, this recovery of about 4%, could be the start of it. I might be wrong, but the reality is that none of us know. You may buy out on what we call these buying opportunities and end up paying higher when you do buy into the market. So really what I'm trying to suggest here is you've got to take a more measured view and maybe not listen to a lot of the noise that's out there, and understand the reason why you're investing. If this is to do with your pension fund, and if you're in your 20s and 30s, you really shouldn't make any reactive decision because you've got 10 plus years to wait. You will more than likely see this short-term fall out. There is no doubt in my mind. And again, just to reiterate the point that I've already mentioned, you can see how often markets fall. You know, we've seen a 10% drop on average every 1.1 years. It is not unlikely, it is not unexpected. And in some cases, it can actually be a good thing because it's this, you know, correction that must take place in order for markets to spur on. Again, if anyone has any questions, guys, please do put them into the chat function and we will look to address them. And I know people are going to say this time it's different, you know, Trump is different, but he's not really. He's been in office before now. Okay, I appreciate that he's taken a very, very, you know, active view on what he's doing with tariffs, for example. But in some cases, they were almost likely to occur, and they're not out of sync with what the Fed are looking at. President Trump wanted to reduce interest rates yesterday, but the Fed didn't take any notice of him. And this is the thing we have to understand, that whilst Trump moves markets by comments that he makes, his bark tends to be worse than his bite, and he generally tends to roll back. Now, again, I'm not trying to predict the future. I do not have a crystal ball. But the point I'm trying to make is that if you look back to 2008, which was probably the most significant period that any of us will remember, and I'm 51 years of age, and I can say that categorically. As I mentioned earlier, we've seen a huge recovery for those people that could wait for that. When COVID struck 5 years ago, we saw a 30% fall in markets in the space of 2 weeks, and yet it recovered 3 weeks later. So if you went out of the market during that pullback, you would have missed the 30% pickup within the first 3 weeks of that recovery. And by the end of the year, you would have lost out on growth of what was another 20% on top of that. Really significant. So the key thing again is, and I'm going to keep repeating this message through there, There are many reasons why we may have a view that markets may fall, and they're all very valid, including President Trump, trade wars, the debt situation in the US, the fear of inflation. But there are also many reasons why markets may improve. The States is still performing very well. Trump can be positive towards markets, believe it or not. He has been in the past. The fact that interest rates in the States are going to fall, we expect 2 more rate cuts. What we don't expect is more cuts on top of that, which was really reaffirmed yesterday. And then inflation is generally under control, even though it's slightly outside of the mandate for
So,
the
Nick,
US.
before you move on, we've had a few questions in, and I might just ask them now if that's okay. So, for somebody, they said they're 66 in a few months, so they need security around their annual income from their pension. What should they do now?
Well, the first thing is get advice. And for anyone that's on this call, respectfully, if you haven't heard from your advisor in the last number of weeks during this pullback, I would suggest to you that you should get advice, probably from someone else. We've been very active in Alpha Wealth in talking to our clients and mentioning them, and that's part of why we're doing this webinar today, to explain to them about the fact that it's really important to get appropriate advice for you, not for what people say that you think you should do, because it's not a one-fits-all solution. And to answer that particular question, having a pension fund as 66 years of age does not mean that it should be in a safe haven. And the reason I say that, and it might surprise some people to think that you should have risk in your 60s when it comes to a pension fund. But pension funds in your 60s are investment vehicles. Typically, for the vast majority of us, we have a fund that we look to draw an income from. And that fund can be invested. And I'll give you an example of one or two things in a moment, where yes, it could fall in what has happened in the last month, but over the next 2 years, 5 years, 10 years and beyond, we're going to expect that this is going to recover. And the key thing is that we're going to get more growth than we will if we leave it in a standard savings account. Because one thing I can guarantee you is that if you have money in cash, you will lose money over a long period of time. And that might surprise you and say, well, how is that possible? Inflation is the problem. Inflation running at about 2.5% means that if you're not making 2.5% a year, you're losing in real terms. And whilst that might not seem like a large number, if you extrapolate that out over 10 years, simple math will tell you that that's 20 to 30% compounded over that period. It's quite significant. And for anyone on this call, if you have a pension fund and it's in a fund that most of us will occur, which is an investment, you should be invested, but it needs to be appropriate to the amount of money that you have and what money you may need in the short term. And this goes to this slide where the main thing is look at what amount of time you have. So for example, for that individual, the income that they need this year, they should have it in a low risk fund, generally speaking, a cash fund, because they have no time to recover from a pullback for the monies that they require. And that includes the next 2 years. However, if they have a 3+ year time frame, they can have money invested in the market. Now, it needs to be commensurate to the amount of time. And if they've got a longer term duration, they can have more risk invested in the market. And these are the 3 different pots that I keep talking about. And I would like to remind you that, if you have need for money, if it's an investment or a pension fund within the next 3 years, it should not be in any investment. Not because we think markets are going to fall. It's because we can't react quickly enough if they do. So to move on to that, where should you put money if you require it within 3 years? Well, certainly not in an Irish bank account, in my opinion, not for a lump sum. And the reason I say that is respectfully for AIB, Bank of Ireland, PTSB, where most of us probably have our current accounts. If you have money in there that you may require access to in that 3-year period, but you can earn interest of up to 2.6% in a non-Irish bank, namely some of the foreign banks such as Raisin, which I'm going to mention in a moment, where there are no fees, there's access to your money, you can fix it for certain periods where you can fix the interest rate, you get more security of your money, and you have the ability to draw it within one day or indeed fix it for certain durations. But for monthly savings, this is where you save, 100 a month, 1,000 a month, whatever the figure is. The Irish banks are the banks of choice. You can set up online savers with them and have your money invested monthly in a fixed account with no risk, gaining 3% currently with AIB Bank of Ireland and 2.5% with PTSB. The key thing, though, is to watch for terms and conditions. A lot of people I speak to have gone beyond the key term, which is 12 months for most of those accounts, and effectively their interest rate has gone back to zero. So please be mindful of paying attention to that. I mentioned Raisin Bank earlier. This is a screenshot. Now, the rates have fallen slightly over the last couple of days, but you can see there with Nordax Bank, which is currently paying 2.61% for a AAA rated Swedish bank on demand, in my opinion, makes complete sense to all of us. And if anyone's not sure about Raisin as an institution, and they are a platform, a one-stop shop for all deposits you may require, not for monthly savings, but for deposits, whether it's a bonus, monies you already have, monies you may be in receipt of from the sale of shares or wherever it might be. In my opinion, it's definitely worth exploring. And I can send you a video where they give a good indication of why you should look at putting your money into them. And we have
And
absolutely
before
no
you move
bias.
on that, another question just in, and we will get to all the questions, and I'll keep a lot of them till the end. But is a De Giro ETF account any safer than an ETF account with Trade Republic or Bunk?
No. And the key reason is that there's two things going on there. I think you're asking about the security of the institution, like De Giro versus Trade Republic or Bunk. But an ETF has risk guides, and I'm going to talk about ETFs in a moment, but this comes back to if you have time. So first and foremost, don't have money in an ETF if you do not have a minimum of 5 years. Why? Because I've explained earlier, you don't have enough time to recover from a pullback. And as I said to you, the market has crashed on many occasions and it's always recovered. But it took about 8 years for it to recover back from what happened in 2008. So again, you need to be mindful. I'm going to cover off that question in a moment if it's okay, but just to quickly mention, anyone who has individual shares, I'd be very mindful of that if in this climate, because those shares could suffer more than the market, depending. I showed you Tesla's performance, which has been terrible over the last month. And there are other reasons why that has happened. But if you look at individual shares, many people that are on this call may have shares in the company they work with. I keep saying to them, you should diversify your risk because of the fact that whilst you might believe that those shares will perform well and that they may recover, the key thing to note is that it's about not having too much exposure in any one asset class. We all have bias if we have shares in the company we work with. For example, somebody who's been working in Pfizer, respectfully, those shares have actually fallen in the last 5 years, which is incredible because we've got other companies like Coca-Cola where the share price has risen. Other companies then like the NASDAQ, which is an index that has risen considerably. Lilly shares have done incredibly well. And yet people who work in Pfizer should sell and people who work in Lilly should sell, but for different reasons. But the one common reason they both have is that they've got too much exposure to that one share. And if they ask themselves truly, the only reason they have that much exposure is because they work there. Now, a lot of people may not
And
sell the
before you move
shares.
on, sorry, Nick, it's just a few questions have come in that are kind of pertinent to the actual slide that you're on. So another question is on social media, there's a lot of noise about people saying that now is the best time to buy because it's like the market is on sale. Is this good advice?
No, I don't think it is. They talk about this buying on the dip, and you might have inferred from what I've said already that now is a good time to buy. You can't time the market, guys. The key thing to know is why are you investing in the first place? Because the people that are buying on the dip, they're speculating, and we're not investing to speculate. We're making a measured financial plan, and we're saying to ourselves, okay, I have a sum of money. I am prepared to invest for 5 years, 10 years. And I know though we may not have an exact time frame, we need to recognize that it needs to be cognizant to the fact that if we invest in that ETF or if we buy on the dip, it may not go favorably in the short term. And we need to then realize that we need to give it time. So the key thing I'd say to those people is if you're in a position, and again, you need advice, in my opinion, make sure that what you're investing in is diversified. Do not buy an individual share because you feel that it's fallen. So some people might go and buy Tesla shares because I've shown them a chart of how Tesla's share price has fallen dramatically. That does not mean it's going to go up, I can assure you. And the key thing I'd say to you is that make sure that what you're doing makes sense. For example, looking at the S&P I mentioned earlier, I come across so many people that have bought like the Vanguard S&P ETF. And I know that may not mean something to many people, but just to recognize it's like buying the market in their eyes. But I don't like it for a number of reasons. Too much concentration in the States, too much concentration in equities. It mostly is tech based, which unfortunately, when tech is doing poorly, which it has done over the last month, you tend to suffer more from. Sometimes you're taxed more heavily. The tax treatment on ETFs is not that favorable. It's 41% on exit, and you have to pay every 8 years whether or not you take the money out of your ETF. And it tends to be high risk. So again, I go back to the fact that whilst I'm not saying you shouldn't have exposure to the S&P 500, the key thing is don't have too much exposure. A lot of people ask me about buying investment property or should they sell an investment property? And I always say to them that the decision has to be measured and there are always pros and cons. The pro of having an investment property is obviously the rental income. And if you're a lower rate taxpayer, or if your partner is or your spouse, it may be sensible to hold that investment property in their name and you can benefit from the rental income without paying excessive tax. But if you're a high rate taxpayer and you're going to pay 52% on the rental income, I'm not convinced it's as attractive an investment. And then you have to deal with other issues such as obviously the issue of tenants not paying rent, the problem of obviously the tax, and as well as the government maybe providing you with rent caps as they've done. So there can be a number of considerations, but I'm not saying it's a good or bad thing. I'm saying it has to be measured as an overall part of someone's portfolio. But if you only had 200,000 and you wanted to invest it just in property, it's not a good idea purely from the basis of it's too much exposure to that one asset class. And this particular asset class generally tends to be illiquid. We try to provide solutions to our clients, and one of them, which is that we set up, was called the Alpha Savings and Investment Club. This was trying to help people understand and recognize that you can put your money in the market, as I call it, as long as you have that 3 to 5 year plus time frame. And you can put money in on a monthly basis, you can put it in lump sums. We manage this account on your behalf. We ensure that you get the lowest fees possible, which typically tends to be all of your money invested with a low management fee. And it's really important to look at what you're already invested in. I said earlier about, the types of funds that we try and advise our clients to have exposure to. I've listed two of them on the screen, which I believe are best in class through one of the providers that we use, which is Zurich. Prisma 4, which is a medium risk fund, typically on a scale of risk of 1 to 7, that fits in the middle. Prisma 5, which would tend slightly on to the medium high risk scale. Now, there's a lot of information on the screen, but if you look towards the bottom of the screen, you can see on the left-hand side the performance of Prisma 4 annualized over the last 3, 5, 10, and 12 years has been roughly 6 to 8% per annum. And on Prisma 5, 10 to 12% per annum on in general. To me, that's a significant return in periods where we've had massive market pullbacks, 2022, 2008, and so on. And the key thing to note, guys, is that you've got your money actively managed by a professional. I do not manage my own money for one very specific reason. Whilst I have the knowledge, I don't have the time. This is an example of a savings plan that I have with Zurich. I'm saving 279 euros a month. I have exposure to three funds. One of them, Prisma 4, which is the medium risk, which is the 3 to 5 year money that I want to have access to. One of them is Prisma 5 and also gold, which I have a small exposure to, which is my 5 year plus money. It has no bearing on what my risk tolerance is. It has no bearing really on what my view of the world is. I'm letting what I believe to be one of the best investment managers manage my money and make those decisions. And I've made 2,000 euros on that savings plan over the course of the last 3 years. I'm not particularly concerned with what's going on in the world. The key thing is that I expect Zurich, as I'm showing you on the screen, to have made corrective decisions around whether they're overweight in shares or underweight, where they have exposure to shares. It's not about being out of the market. They've moved a lot of their holdings towards European shares because they know that those shares are likely to perform better, particularly in defensive stocks. They've also made reference to the fact that they've increased their holding in gold in these diversified funds. And I'm not trying to kind of beat the market. I just want to have exposure. Zurich, as I've shown you, offer funds like gold where you can get access to that. And I showed you over the last 12 months returns of over 40+%, which is significant. It does not mean it's not going to perform in the next 12 months. I've already said to you, based on my own savings plan, I believe it will do. But more so is I don't mind the fact if it doesn't, because I've got the time to ride this out.
So, Nick, before you move on, just a question in what are the tax on these savings funds?
So at the moment, these investment funds are taxed in the same way that ETFs are, which is this what called deemed disposal, currently 41% on the gain. Now that may seem quite high, but it's only on the profit you make. And yes, it's deferred for up to 8 years. Jack Chambers, the finance minister, is currently looking at exit tax and looking to reduce it in line with capital gains. He's following on from a proposal from Michael McGrath, who had started this last year. But the key thing is that despite whether or not it does fall, I believe firmly that it's really important to make sure that your money's working. And yes, unfortunately, the tax man is looking to take money on gains of any investment, but there's two of which that we can benefit from where he doesn't. And one of them is through a pension fund. So looking at your exposures at the moment, I would say to all of you, are you taking advantage of tax opportunities? Are you looking at your pension fund as an investment and maybe considering the fact that because if you're earning over 44,000 a year, you can get 40% tax back on your pension scheme? Maybe that's an opportunity whether markets go up or down. You're going to cushion yourself against any loss, and you do not have to have risk in your pension. But again, depending on the time frame, in my opinion, I think you should. If you or your partner have worked in the UK over the last 30 years, there's a massive opportunity for anyone listening to this call before the 5th of April to buy back over 19 years. And I've said this to many people, and still many people have not taken advantage of this. This is the best investment you could ever do in your lifetime, and it doesn't require a lot of work. I did it successfully myself a number of months back, and I would encourage anyone on this call to look at this.
So just
I've
before you
made
move on the pension side of things, there's a question in prior to the US election, I was looking at changing my pension from the Empower High Growth Fund, which is a risk category 5, to the Indexed World Equity Fund, risk category 6, but I've held off. Would you think now is a bad time to go to a higher risk category fund? I'm 38.
Yes, I do, but it's not because of the fact that markets have fallen. It's because of the fact that you're 38. The earliest time you could possibly draw your pension in Ireland is from the age of 50. But more so is that you're typically only drawing a quarter of your pension fund at that stage, and then the 3/4 of your pension is going to be basically paid to you over the duration of your lifetime. So it makes sense for you, regardless of whatever happens in the next 6 months, 12 months, 5 years, and so on, to have your money invested aggressively. And therefore, the World Index Fund that you've referred to, in my opinion, would be sensible, particularly for your monthly future contributions. Because you're 38, most of your pension money is going to be made up of the future payments you make. And because you can buy into those every month, you're reducing the risk. One of the things that, what I speak to clients about is that if you're worried about time in the market and that maybe now is not a good time, you can phase into the market. A lot of the companies offer this thing called auto investment, where if you had a sum of money, let's say 10,000 euros, that you had 3 to 5 years to invest in, you can invest that money. And what they do is they drip it in over a period of 12 months, where they buy 1/10 into the market every month, which reduces your risk. And if at any stage you want to pay the remainder in, you can do so, which is quite a good mechanism to use. Personally, I'm not a massive fan of that, in that I always say to people, if you have money to invest, do it today. Don't do it tomorrow. You can't do it yesterday. And the reason I say that is because the key thing about investing is how much time you have from the day you invest to the day you get out, and make it as long as possible to recover from any pullbacks. That's a really key philosophy that I would say to people. Okay, looking at why is it so important to get growth in your investment? The graphic on the screen here, and this could be actually relevant for the person who asked the question. The difference of 2% growth, which could be the difference per year on the Empower High Growth Fund to the World Index Equity, that's what it typically would have been over the last 10 years per annum, would give you a difference over 30 years. And again, you might say, why 30 years? Well, again, a lot of the pension money will be drawn in your 60s and 70s of over 125,000 in this graphic. So you can see why it's so significant. And that's not just over 30 years, that's over 3, 5, 10 plus years. And for
So for
anyone that
somebody,
has
Nick, sorry to interrupt, but there was another question in saying that this person is in their early 30s and it's similar to the last, but both my pension and my savings investments are in high risk funds. I'm reasonably comfortable to watch them fall over the next period and continue to invest during this period. Is this the correct thing to do? Or should I move my investments to a low risk fund and continue to invest? And I think this slide is obviously testament to what you've said kind of previously.
Yeah, but there's one thing to add. It's not just about the risk level, guys. I have no issue with risk. And if you've got a 5 to 10 year time frame, yes, you should accept risk. The point is, though, is it diversified enough? For example, the earlier question was talking about the world index equity. That's 100% equities. And then you can get risk from other asset classes like alternatives, like gold, oil, and so on. You've seen from my own savings plan, whilst I have no desire to access a lot of the money, gold being a risk asset gives me a slightly different exposure. It's the same reason why I don't invest in the S&P 500. I have my money invested in other assets that are equally as risky, but more diversified from an asset perspective. And that's the main thing. For example, on the screen there, that's another form of you getting tax back. There's only two ways in Ireland that we can get tax back typically as employees. One is our pensions, and the other is a scheme called the Employment Investment Incentive Scheme. You can invest in one of these indigenous Irish companies. There's over 50 a year that look for finance. We've done various webinars on these. And again, this is today just to give you an insight into why it's really important to get advice. You can put a figure of say 5,000 into one of these investments and get 35% back from the Irish government. That's significant. You make a decision to invest with advice, obviously, from an independent financial broker like Alpha Wealth. And over the course of 4 to 5 years, you'd expect your investment back plus growth. This is certainly something that I personally would suggest would be a diversification away from pure equity. Now you might think, but yeah, investing in Irish companies seems risky. Yeah, there's risk inherent, but this is where it comes back to being commensurate to the portfolio that you have. The main principles, guys, are stay disciplined. Volatility, as we've witnessed over the last month, is part of investing. And if you can't tolerate it, then you need to ask yourself about, are you reasonable to the fact that you would have made a lot of money in a risk asset like a world growth fund in the last 12 months? It cannot all be one way. Keeping your money in cash in the long term is not an answer, and trying to time the market certainly isn't either. You will be rewarded by having your money in risk assets, but they need to be diversified. Don't hold too much money in one company, and don't have it all in equities. And again, make sure that whatever you do, that you review your financial plans at least once a year, because unfortunately, it's not just about your own life situation changing, but also the events that we see from the market. I just want to finish up by saying that for anyone listening to this call before the 27th of March, I am going to be doing a webinar talking about a principle of what's called FIRE. This is the Financial Independence Retire Early, really bringing together some of the concepts that I've spoken about today as to how you can put yourself in the best position with proper planning to reach all your financial goals, including being in a position to become what we call financially independent at your earliest possible time. That could be 50 for some people, it could be 55, it could be 65 and beyond. It's about taking the straight path and avoiding those bumps and sideward bends that some of us unfortunately may take part on. And I would suggest to you that it would be a very relevant webinar for people. Finally, for anyone who is interested in booking a financial review with myself or my colleague David Looney, we offer two types of financial review in Alpha Wealth. It's a once-off fee to do all of the heavy lifting and to give you appropriate advice based on your financial position. And you can book in using the QR code on the screen. going onto our website, Alpha Wealth, or indeed reaching out to the email address that's on the screen, info@alphawealth.ie. If anyone does have any further questions, please do feel free to ask them now. Obviously, I'm more than happy to stay and answer any questions that you may
Yes,
have.
so I have a few other questions here that have come in. What about investing in arms weapons shares? Are there any diversified ETF ones? I have a 5-year window.
I wouldn't do that purely because of the fact that, as I've explained earlier, the problem with doing so is that it's too specific, and you may have already missed the market because markets react very quickly. And whilst I'm not saying buying into companies that are more prone towards defense, we've noted recently, obviously, Germany has performed very well. They spent a lot of money in European defense, but the reality is that could change tomorrow, and what you won't be able to do is to be able to be in a position to manage that effectively, which is why I'd prefer for the money to be invested more broadly, where you have an investment manager that's making those decisions on your behalf.
I am 2 years from retiring in a lifestyle fund. I could switch to a Prisma 3, 4, 5 fund. Would you recommend it at this stage of my life?
I would certainly look at de-risking that 25% that you're looking to access tax-free from your pension scheme. And typically, yes, going down to the likes of a Prisma 3 now, moving down to the likes of a cash fund in the last year for that portion would be sensible. And for the 3/4, I would be toitering around Prisma 3 and Prisma 4. But when you do draw down your pension scheme, you are absolutely in a position then to ramp up and go into more aggressive funds in the way that I explained earlier, because your horizon has become a lot longer. But in that instance, it would be worth maybe talking to a professional around how to best position yourself.
That's it with all the questions. So I'll hand it over to you to wrap it up.
Great. Listen, thank you very much again for your time today, guys. I'm sorry that I couldn't get my camera working, but I hope you've been able to take something from the call today. Please feel free to reach out to us if you have any questions. Again, we're happy to answer them. If anyone is interested in booking in for the webinar next week, my colleague David Looney is doing further webinars as well. He's going to be doing one on redundancy. If anyone may be liable to redundancy, perhaps in the next number of months, I do think it's something certainly to look out for. And as I said, really the main message I want to give you today is get appropriate advice to your own specific needs, and make sure that you've not got too much exposure in any one particular asset class, and try not to get too laden down by the noise that unfortunately we tend to hear often. Thank you very much again, and enjoy the rest of the day. Thank you.